What's up, everybody? We're going to be starting here in 30 minutes with Chief Market Strategist, Matt Maley. A lot of you guys know him from the Benzinga options chat room that he has for, for trades and things like that. But yeah, a lot of you guys have also seen him on Bloomberg TV or Yahoo Finance because he does interviews out there. But we'll be starting, folks, in about 29 minutes. Stick around. Do whatever you have to do. Just make sure that by 5 p.m. Eastern, you're here, ready, good to go. Because we have a great session planned for you guys. So stick around and we'll see you guys in a bit. Hey, what's up, everybody? We're going to start here in 17 minutes with Chief Market Strategist Matt Maley. He's a Chief Market Strategist at Miller Tabak. That's an equity firm. A lot of you guys have seen him already on Bloomberg TV or Yahoo Finance or CNBC Asia. He's all around the news. They interview him. Or you know him from the live trading room that he has here. So he's actually with some of the members right now in the chat room. So he's going to be here in about 16 minutes. And then we'll get it started. We have a great session planned for everybody. So stick around. Make sure you get everything done and ready. And shout out to Ray. How we doing? Miguel, Trader Joe. What's up? Patel, CJ Patel. Good to see you. Yeah, folks, 16 minutes and we're going to get it started. So just stick around here for a bit and we'll get it going. Ladies and gentlemen, we're going to start here in about 7 minutes with Chief Market Strategist Matt Maley. He's a Chief Market Strategist at Miller Tabak. He was a director of trading at Merrill Lynch as well for about 10 years, 11 years. And he was at Solomon Brothers as well for about 12 years or so. So this is pretty much a career Wall Street, and basically he's going to be here with us. We're going to be talking about stocks, trade ideas, education, setups, tickers, what's going on in the markets right now, and of course 3 simple ways on how to profit during the bear market. So very interesting. Matt Maley's pretty good at trading the volatility. So he's going to be here with us, guys. Just make sure you're ready here in about 6-7 minutes once we get everything started, and we'll be good to go, folks. What's going on, everybody? Welcome to the session we have today here with Matt Maley, special guest for the day. Basically, Matt Maley, chief market strategist at Miller Tabak for about like 12 years around there. Director of trading as well on Merrill Lynch, 10 plus years. Solomon Brothers as well. In Merrill Lynch, he managed, two of the biggest accounts there, Fidelity and BlackRock. So some really good experience on the back end for Matt Maley. And so we're going to get started here in a bit, folks. Shout out here to Boone, Cisco Diaz. What's up, man? George, Peter Shredell. This guy does not miss one session, always here. Shout out Miguel. What's going on? Law Texas, Johnny Wacko. What's up, man? Glenn Vital, Trader Joe, Tatro, Susan's in the house, Veneer. All right, we got a pretty good crowd here. Really nice crowd. Folks, my name's Rodrigo. I'm going to be here with you today. We're going to talk about trade ideas, education, what's happening in the markets, 3 simple ways on how to profit during a bear market, setups, a lot of things. We have a great session planned for you guys. So thanks for being here. Let me know in the chat when you guys are ready to start, and we can go ahead and get things moving here on our end while I get some of those things set up, guys, on the back. Just let me know when you're ready in the chat, on the YouTube and on the Zoom chat. All right, we took care of that. What's going on? Henry's here as well. Investor Crib. What's up, man? What's going on, guys? All right, so Andre, you ready? Ray's ready. 1H Fool is ready. All right, guys. So yeah, we're definitely going to get it started here. Let's go ahead and bring here Matt Maley, chief market strategist at Miller Tabak. And also lead trader at the Stock Picks Inner Circle chat room. Let's go ahead and bring Matt in whenever he's ready. Matt, let me know. Hey, what's going on, Matt? How you doing?
Hey, what's going on, Rodrigo? Let me just turn it up a little bit there. Okay, good. Good, boy, what another crazy day. It's exciting for the markets, but it's I mean, it's a lot of fun, but it's also can be, it's so unique right now because, for so many in the past, the big thing is that, when we've gone through these very volatile times, especially if we're headed towards and are, moving into a bear market or at least a deep correction, the individual investor really hasn't been able to participate. You're just going to have to weather the storm, grin and bear it, maybe raise a little cash. Shorting stocks is very, very difficult to do. Buying puts was very, very difficult to do because they only expired quarterly. They're very expensive. But now we have a lot more tools at our disposal, and it's something that we've been able to use very, very well. I mean, here, especially with our and the Benzinga, what do you call it? I guess a tier 4, but the inner circle chat room that we have. That we have going on every day, 5 days a week when the markets are open. As the markets are open, and we start before the markets open. A lot of days we don't really start until 9 o'clock or so, but other days, earlier this week when the market was really moving, we were on the chat very early, but 7:30, and go until 4:30, 5 o'clock, and just talking about different ideas and what can work, so we can not just survive, not just weather this thing, but to actually profit from it. So it's been working out real well, and that's what we're trying to do, and we want to talk about the ways that we do that here today.
Yeah, and a comment here from Tammy on the YouTube chat. I've learned more from Matt than anyone on Benzinga, saving up to join his inner circle. He's a godsend. Thank you. So you got a nice loyal fan there on the YouTube chat there, Matt.
Thank you very much.
Do you want to go ahead and share your screen?
Yeah, let's get that going. And okay, share. Let me just hit the escape button. Oops. There we go. Can you see my Bloomberg thing there, Rodrigo?
Oh, yeah. I think we're all good to go here now. So, but yeah, I was telling the folks that you were in the chat room because I know that you put your, all your entries and your exits for the trades. And I actually recently took, I know that you were like a couple days ago, you were shorting the Qs on puts. So I followed that trade. I know that you put the exit like around 3:50 p.m. So that was right on the last dip on the market, right before it ripped higher. And I also bought those calls that you bought right after you sold those puts. So it's just it's, you know, like, I'm glad that I just follow the trades that you make, those picks, and have that you have them there, because it's pretty straightforward. It's like, okay, I'm buying the puts, okay, I'm selling the puts, and I'm buying calls now. So it's as simple as it could be. But
Yeah, and that's really what,
powerful.
what it's funny because I'll just show everybody here with my screen. Don't worry, I'll blow it up so you can see it better. But what Rodrigo's talking about is that last week, whoops, do I have the right one? Yeah, there they are. I just want to blow it up a little bit so you can see it better. But these, this last week, we're looking for the end of the as the market was really coming in, we had a lot of negative news. Everybody was, we had the market was bouncing back a little bit because we had some negative stories about how Putin was getting into some peaceful discussions and everything was hunky dory. And my comment was, well, whether this thing is going to turn out to be nothing or not, it doesn't really matter, because the Federal Reserve is still hiking. They're going to, we're at the precipice, or right at the beginning, or at the end of their QE program. They're basically finished that on Monday, or Monday or Tuesday, and we knew that was coming to an end. And the stock market had been pushed far beyond its fundamental values, and it was just a matter of time before the market hit. So I came in and said, hey, let's get in here and buy some S&P puts, because I'm sorry, but I talked about actually the QQQ puts, but we also the S&P and which is the SPY. The QQQ puts, of course, are the ones on the Nasdaq 100 index. We also look at the IWM puts, which are the options on the Russell 2000 small cap index. Anyway, I decided to go with the QQQs, and it's the one we've been trading mostly recently because they're the most volatile, which of course gives us the biggest bang for our buck when they do see big moves. And sure enough, we came in, I should have put QQQ, but it's the QQQ February 25th, 330 put option. So this was on the 23rd, this was on Wednesday. And at about 1 o'clock, we went in and we bought these things. And sure enough, the shooting started the next day. And one of the things that the people were talking about was that, what usually happens is when the market sells off on this build up to build up to war, but when the shooting actually starts, the market usually rallies back. So sure enough, what we did is we came in, we bought these QQQ put options. Overnight, Russia invades, and of course these options just took up. They went up almost 400%, 392%, literally from just after 1 o'clock, so about 1:30. And on the opening the next day, and when we came in the morning, we were on the chat room long before 9:30 that day. But about quarter after, I said, "Listen, quarter after 9, that is, we're going to sell these puts. We're getting out because the shooting just started, and if history is any guide, this market is not going to stay down for very long. It's one thing. 9/11, of course, was a complete surprise, so the market, of course, stayed down. But when the market sells off, we have the buy the rumor, sell the news. When it's negative news, you sell the rumor and buy the news. Well, the rumors that they were going to, there's going to be invasion, and the news, when the news being the actual shooting, we thought it would rally. So I wanted to get out of those puts right away, and we sold them for a nice profit of almost 400%.
These are trades from the chat room, correct, Matt?
These are trades. We put them right in the chat room, very specific. February, again, I on this chart, I usually when I put the chart, I put the actual thing, but it is the QQQ, February 21st.
Right.
The strike price, what the expiration date, the specific trade, what time we trade them. I don't put on the trade and wait 20 minutes and tell people about it. Let's go. This is the trade. We're doing it now. And then in the chat room, we have a separate page where I go in and say, okay, this is what I'm doing, because the chat room just scrolls by. It's hard to go back and figure out, well, where did geez, I went out and got some lunch. I came back. Did he do something? Well, am I going to scroll through this, a half an hour worth of or an hour worth of chat, or the chats to try to figure out if he's done something? So we put this on the other page so that you can, when you're off the desk, if you don't see it, you can see that a trade we put on. And then this one, though, one is, as I mentioned, that we wanted to sell it right away because we wanted to make this profit. I was worried that the market would bounce back. I didn't know how quickly it would bounce back, so I didn't jump right in on the other side, but we completely flipped it, okay? And then literally later in the day, So this is now the 24th. Remember, this was the 23rd. This is the 24th. Now we're on, whoops. Now we're on the 24th. So at about 10:30, just after 10:30, I said, okay, let's go ahead and go in and buy the calls because the shooting has started. The market has not followed through to the downside. I didn't get the exact bottom. If anybody's, and sometimes you can get the exact bottom or the exact top and sell it, buy at the exact bottom, sell at the exact top. It's very lucky when you do it. And when you're making 300%, I don't worry about it. So we came in here because I wanted to see, will we see some, at least a little bit lower lows in the overall market, or will it bounce back immediately? Once we got an hour into the day, I realized this market's going to stabilize. It's probably going to rally. We bought the call options, again, specific, February 25th, $322. That was the strike price. Call options. We bought them here. And later in the day, I said, we're up 300%. Let's get out. We're not going to be greedy. I didn't get the top. If you held on for longer, we would have gotten more. But 300, almost 400% on one side, 300% on the other, and a day and a half. We're going to take that every time.
So, okay. So just for the folks here that are new, let me just put this in context, right? What Matt is saying, like, so basically, when Matt bought puts, the puts went up when the market went down, and then he bought calls when he called the reversal on it. So that's when he sold the puts and pretty much bought the calls and then made money.
Lag time, but
So this is what people say, that you can make money on the way up and on the way down. So this is pretty much like literally what Matt is doing. So trading the volatility, literally, this is the most simple type of trade of options that you can make. It's nothing like, you're not doing spreads, Matt. You're not doing nothing complex. We're literally just doing basic calls and puts, right?
Right. I mean, once in a while we'll do a strangle or usually just a straddle, but even and I haven't really suggested that in a couple of weeks, although some people have traded those on the chat room. And that's the other thing too, is that people are giving each other ideas. I'm not the only one throwing ideas out there. Especially yesterday, I was more cautious on the market. I didn't think the rally would last as long as it did. There are other people in the chat room who were, and they profited very handsomely, and they were giving each other ideas. And I kind of stayed on the sidelines. So I don't pretend to get every trade, and every trade I give isn't always right. And what we do is that the vast majority of them are good. More importantly, we let those ones run and get real good gains on them. And the ones that we lose, we try to cut the losses, keep those to a minimum. But I mean, the whole point is to make a lot more on the ones you win than you lose on the ones you lose. But even more importantly, to have a lot more winners than losers, and it all adds up very, very nicely.
Yeah.
So
I think that if you do 500% in a day and a half, like, I think you're going to be doing all right. Yeah,
exactly. Yeah. I mean, the whole idea I try to do with this chat room and the newsletters is just that, people can, the cost of purchasing it is something that pays for itself very, very quickly. That's what we're looking to do. I mean, you buy a brand new car, you drive it off the lot, it devalues immediately. This one, we want it to be increasing in value the whole way through. This is, it's a service. It's not an asset, a hard asset.
And these times right now, like, I mean, for people that are starting to trade, Matt, like, it's different. Like, if people, if you started during COVID, it's like, okay, there's one theme, right? Everything goes up. And then, then you have the aftermath, right? Where all these new traders, are having so much difficulty navigating the markets. And really, this is where, your 40 years of experience in Wall Street kicks in, because you've lived through situations that are similar, and you've lived through them as a trader, right? When you were at director of trader there at Merrill Lynch, right. and from the strategy side as well.
Right. I mean,
Payback.
Yeah, I spent 15 years at Solomon Brothers, the biggest trading desk on Wall Street. And again, that's the other thing, is I'm a strategist, but my background is 25 years of trading. I covered the biggest mutual fund in the world. I covered the biggest hedge fund in the world, Fidelity and BlackRock. Many of the biggest mutual funds, hedge funds, insurance companies, you name it, other institutional money managers. And I covered the trading desks. So I didn't focus on the theoretical stuff, what should happen over the next 10 years. I cared about what is happening now. So for people who are more active traders, believe me, the fundamentals are always important. but I use so many other tools because I learned very quickly that what should happen over the near term isn't what should happen over the long term doesn't always happen, number one. And number two, it can frequently go in the exact opposite direction than the fundamentals are telling you. I mean, all you have to do is look at Amazon. In the last 25 years, the stock is up a gazillion percent, and yet it's had, just in the last 10 years, it's had 24 corrections of anywhere from 20 to 60%. So the point is that even the best stocks in the world see pullbacks. Last year, Apple saw 5 corrections. 5 corrections. The stock market went straight up all year long. The market never went down more than 5%. And yet this stock went down between 12 and 20% 4 different times. And you want to be able to take advantage of that. And I guess the biggest thing though right now is, again, I'm focusing on not just the fundamentals, but the technical analysis, positioning, sentiment, all these things that kind of combine together. You have to look beyond the fundamentals to really maximize, especially when you want to be an active trader. You have that big long-term bucket, and that's great. You want to put money like an Apple and just let it sit there forever. That's great. And you should have a part of that. Have a bucket of that. The other names, though, is if you have more interest and you really want to maximize your returns, whether we're in a volatile bear market or a deep correction, or in a bull market, you still want to be able to make it both ways. I mean, last year when the market was going straight up, the biggest trade we had was Viacom, where we made 2,500% betting on Viacom would go down. Okay, 2,500% on the options. The stock. I'll show you the chart in a little while. Why? I'll tell you why. The reasoning we went behind it, and that's one of the big things I try to do. At the comment at the very beginning saying that I learned a lot from me, and that's great. That's kind of my big thing. I love being a teacher. It's what I do. It's what I've been doing my whole career. I trained a lot of people in the trading area. And again, Salomon Brothers for 15 years, Merrill Lynch for 10 years, or almost 10 years, so about 25 years in the trading business. And so the whole idea is not just to give you some good picks, and not just to have other people in the chat room give you some good ideas, but to tell you why we're coming up with these ideas, and so that you can do this on your own, and you're coming up with your own ideas. And then when you come into me on the chat room and say, hey, this looks really good, and I'll say, yeah, I agree, or something, this is why I think this is not a great play. Because sometimes, oh my gosh, the stock has run up so much. Like right now, the oil stocks have run so much. I should be buying those. It's like, actually, maybe you ought to hold off now. I mean, I'm very bullish on the banks. I'm sorry, on the oil stocks near term. But again, these are the types of things that constantly trying to tell people so they can learn how to do it, right, for themselves, and then get things bouncing off ideas. But like I said, it's not just for bear markets. Last year, when Viacom went out of control, straight up, and I just looking at the stock saying, are they going to cure cancer? Are they going to come up with a new iPhone, et cetera? No, let's buy the puts. Some people didn't listen to me the next day, and when I told them to sell 2,500% profit, they made 5,000%. So they listened to me when they bought them, which worked out really well, and they did even better because they waited a little bit longer. But again, I'm at 2,500 early the next day. I was like, we can't get greedy here, and we move on. So these are the type. This is what I'm trying to help people with, and in the chat room, and right. It's just something that works not only during bear markets, but works really well all the time, but in particular right now.
Yeah, and really quick here. So Kevin Blair in the comment from the YouTube chat, this guy is awesome. I love to watch his content, great knowledge. So it seems like you guys, you have quite a fan base there on the YouTube side, Matt. So and here's the interesting thing too, right? You can use this, and yes, you're trading these calls and these puts, but let's say, for example, right? Like if I were to ask you, so we can, because it has different purposes, right? Like, for example, I could ask you, Matt, if I were to pick one stock and only one stock for dividend purposes only, right? That I could continue putting money in as, and just continue reinvesting whatever I get in dividends. If it could only be one, which one would it be?
Well, it's kind of funny. Right now, I mean, I wish you'd asked me that a year ago, because I was pounding the table on Chevron, which at the time was yielding almost 8%. But the ones right now. Hold on a second here. Let me.
And do you really think it's really worth it for a retail trader to even go that route? To like the dividend route, like absolutely. Okay, that's one of the things that we're talking about. A lot of
some of it's just trades we do in one day over a couple of days. Others go out for a week or two. But we also want to talk about the longer term plays. I mean, one of my best calls, MVIS, that we talked about. We can talk about that later. But the stock ran up. I mean, this is one I suggested quite a while ago. Okay, the stock was way down here and went way up here. We put the stops on it, and when you always want to pay a trailing stop. Okay, the stock came back down. Now we were talking about it on the chat, and this was just the stock. I don't even know if it has options, to be honest with you. And you say, okay, well, it's had a little bit of a run there. So what? Well, guess what? We were talking about this the other day, and boom, boom. This is the stock. Forget about options. Hello, thank you very much. Up 50%. Okay, in 4 or 5 days. So, again, we're talking, and I like this longer term too. Some people sold out. Hey, I made, the person said I made 50% in 3 days. I'm out, and that's fine. I just think that there's a lot of it's the LiDAR technology, that stuff for self-driving cars, but they also have the display panel, the new display panel for smart glasses, so they don't look like something out of a sci-fi movie from the 1950s. They're going to look like regular glasses, like I have on now. And Tim Cook's talking about this, about that smart glasses. The first iteration didn't work very well. The next iteration is going to be a game changer, and these guys have the technology to do it. So we're talking about long-term things all the time. And not only that, I don't care how old you are. Everybody says, when the older people, they're going to be more conservative, and that's fine. But even people who are retired have a little money, say, hey, I still want to play the game. I still want to, go in some tech stocks here or something with a new idea. So they have a little bit of money set over for that. The same thing for younger people. They think, well, geez, I am young. I want to be able to go for those things because I've got plenty. I can take risk. I'm not going to retire tomorrow. I got plenty of time. I'll be making money for the next 40 years. That's fine, but don't only do that. If you go in and buy, if this market comes down more, like I think there's a very good chance, and you've got some good dividend stocks, like a Chevron. Right now, Chevron is rallying, but you're going to get stocks like Chevron was 16 months ago when I was really pounding the table on it. Stocks that are pay 7-8% dividend yields. Okay, and there are companies that increase their dividends every single year, and it's just compounded interest. And you just put it away. You buy a certain amount of stock and you put it in the dividend reinvestment program. You don't need the money. I've got a job. I don't need this dividend like my retired parents need. I don't, and you put it, and it just buys it automatically every quarter. Just buys more stock, and you got a stock that's flat in its back, paying a great dividend, and it compounds itself. So many people, when I was a kid, that was a big thing, compound interest, because you put it in a bank account, you get 10% a year just to have it in your bank. Yeah. Now, of course, you make such paltry amount that nobody cares about it. But think about it. You make $110. You put $100 into the bank, and you have a 10% yield on something. That's great. But next year, because you have it in the dividend reinvestment program, you're making 10% not on $100, on $110. Okay, and the next year you're making it on 120, and then it feeds on itself. And suddenly, 8 years later, you've doubled your money just sitting there watching it. And because you bought it in a bear market, the stock goes up for the next 10 years. And not only have you made a lot of money on the stock, but you've made it through the dividend. And if for something comes up and you say, hey, oops, I got I got laid off or whatever, I'm gonna take that dividend reinvestment thing off, and I'm gonna collect the dividend. I'm gonna use that money to pay for my groceries. Great. Then you get a new job, and then you go off and do it, and you put it right back in again. So don't be afraid for those long-term things. It's not just trading. So I kind of rambled on there, but the point is that looking for these things in the next couple of and over the long-term period, I mean, you really want to be looking at these stocks that are kind of old and not the sexiest ones in the world. But if the market goes down as much as 20-25%, which I think it can, you want to be looking at you want to be looking at these tech stocks get washed out, but don't be afraid to shift some of that money over to that long-term bucket that you don't even pay attention to, and in your 401k, whatever it's be, and say, yes, I'm buying Kimberly-Clark, I'm buying Dow Chemical, I'm buying Chevron, I'm buying some of these big dividend. Again, not just some of them have really high dividends, but you don't have to get the highest dividends. You get the ones that are high, but also have the what do you call it, the record of increasing their dividend every single year. And those suddenly those boring stocks, and you're sitting there and you start at 28 or 25, and then you're 40 years old, and you're just like, where'd that money come from? Wow, that's great. And plus, it's long-term capital gain. You pay it a much, much lower. And when you put it in the dividend reinvestment program, you don't have to pay the tax on the dividend, et cetera, et cetera. So it's just a great way. But let's talk. Just moving to now. The kind of the topic of what we want to talk about here is the bear market. And the title of this kind of session is 3 simple ways to profit or from what's going on in the bear market. Now, the 3 ways, are pretty simple. And one of the greatest things is that, in 2021, and you're making money, people are making money basically on mostly on the upside. We were able to make it on both sides, like I said, with trades like Viacom. And even late in the year when the market was rallying, we made some 200% plays on NVIDIA, some of the best stocks of the year last year. And yet we made money in both directions, both in puts and calls, because we looked at some of the technical analysis that really helped us. And I'll show you the charts on those later on. But anyway, but so the 3 things. The 3 things are, number one, really simply, and we won't spend a lot of time on it, but I do want to talk about it a little bit, is cash. Raise a little bit of cash. If you have some cash on the sidelines, raise a little bit more when the market bounces like it did earlier this week. I'm not saying go to 50% cash or even 25% cash, but 5, 10% cash, even a little bit more as we move through a time here. And I'm going to talk about the reasoning for that. And the key thing is that you'll have a lot more confidence, a lot more ability to keep your head. If the market's down 25% and people are panicking, you'll be the one to keep your head. Okay. And it's just, and even if you don't buy right at the bottom because you're still, oh, geez, I'm a little nervous, I'm going to wait. But then the market starts going up. The market goes up 5% and you buy it. It's like, well, it's going to go up another 80%. You've done well. The person who's panicked, who has no cash, when the market goes up 5%, they'll say, oh, it's finally up a little bit, I'm selling. And they're selling at the exact time they should be buying. And when you have that confidence, we'll go into more of that a little bit. And then we're going to talk about what really is great is that what happened in 2021 when we had so many people made so much money on the upside. And that happened, when did that happen the last time that happened? That happened in 1999, right? I'm not saying we're going to go into that kind of a crash where the market was down 50%, but it's going to be a rough market, much like we had in 2018. I think it's going to last more than 1 quarter like it did in 2018. I think it's going to last much of the year, and we'll see some ups and downs. But back then, nobody had, or the individuals, I should say, no individuals had the ability to profit from downside movement. Again, you could short stocks, but that's very, very dangerous. And if you buy a stock at 20 and it goes to 0, you lose 100% of your money. You short a stock at 20 and it goes to 40, you lose 100% of your money. If it goes to 45, you lose more than 100% of your money. You've got to give more money in. You've got to put more money in. And so that's very, very risky. But and then if you were buying put options, they only expired quarterly, and so you go out several months. It was the time value of those options and the risk that the options traders would put into them made you pay. They put a much bigger premium in it, and so they're very, very expensive. Now we have other things, and that's the second one we're going to talk about: ETFs and inverse ETFs. And we just have before these things are very, very liquid. You have and most of them, of course, are on the indexes. We have it on the SPY, the S&P, the Nasdaq, the Russell 2000. There's also there are also inverse ETFs on groups, on pretty much all the major groups, the banks, energy, technology, semiconductor. You can break it down from there: semiconductors, transportation stocks, retail stocks, etc. They all have groups. Have they all have these inverse ETFs, so we can take advantage of them. And right now, for instance, there's people want to be short the market, but if they wanted to buy, well, especially a couple of weweeks ago, wanted to buy the energy ETFs, you've done very, very well. They've gone up very, very nicely. And they also have the leveraged ETFs. And I'm going to go into those a little bit too. I got to be careful with those. Okay. And then finally, the third way is what we were talking about at the very beginning. What we kind of kick things off with is the options. And again, the reason why they're so much better now You didn't have them in 19 or 2000, and you didn't have them in 2008, and you didn't have, well, you had them in 2018, but it was, they weren't anywhere near as active or as liquid as they are today. And that's the, these stocks, many stocks, especially smaller stocks, not so much, but the mid cap, and large cap names, most of them, and all of the big cap names have weekly options. So you don't have to go out 3 months to make a bet. Geez, I really don't like this market. I want to hedge myself going out a couple of weeks, going out 1 week. You can go out a couple of days, however you want. But in other words, if you've got to buy, if somebody is selling you an option, okay, and one of those market makers, and they're taking a lot of risk for selling you an option 3 months from now. They're taking a lot less risk if they're selling it to you 2 weeks from now. Okay, so it's going to be cheaper. It just obviously it's the math. It's very easy, so you don't have to pay that extra thing. It's like, so if you think, geez, I think this stock's going to go down in the next 2 weeks, that's great. But the only option you can buy doesn't expire for 3 months. So you've got to pay all that premium. Don't have to do that anymore. So you can do it if you want to buy Apple, and again, and then in both directions. So even when the market comes down, and we want to be really, really bullish, same thing. We don't have to go out that far anymore. We can go just weekly options. And then with the index ETFs, they expire again. S&P, they're also the diamonds, which is the Dow. I never really trade those, but the S&P, the NASDAQ, and the Russell 2000. They have the ETFs on those three indexes. They are they have options that expire 3 times a week: Monday, Wednesday, Friday. Obviously, this past week we had just recently the market was closed for President's Day, and so but it was still 3 times. It was Tuesday, Wednesday, Friday then, and upcoming we'll have a Good Friday. The market is closed, so that week it'll be Monday, Wednesday, and Thursday. But the point is, they are very, very, they trade. I mean, you would believe they just trade. They say like May wheat, as they used to say, but wheat's so strong lately. But the point is, they're very, very active. You can get in and out of them, and that's why you can be careful, because sometimes, and one of the things we talk about is like such and such a stock looks great. Matt, what do you think about this on the chat room? I really like this stock, and I'll say, yeah, so do I. But it's a small cap name. Their options are really illiquid. There's a big spread between the bid and the ask, and you could be right. You could be completely right. But if you buy a bunch of them, you might not be able to sell them. There won't be anybody around to sell them. So you have to. It's just not a good play right here. Again, so these are kind of the things that we're talking about all the time, so that we can help get a lot of people get the kind of education that they want. And I've been doing this 40 years, almost 40 years. It'll be 40 years in this fall. It'd be 40 years. If I've been doing 40 years, and I've still learning something every single day. So even there's just so much we can learn, and of course the markets are always changing. But so let's go on. Let's get into it here. First of all, cash. Why? And it's just a simple thing. They don't have to tell you. They say, why would I go invest in cash? It doesn't get me anything. Well, there's some. So Dan Niles is one of the best. One of the most successful technology traders. Technology hedge fund managers. He is a former tech analyst from Goldman Sachs, and he's been very successful. His number one pick for this year is cash. I think he had 20% at one point, and maybe he still does. I don't know where up to date where he stands, but the point is that cash, again, it goes back to a little bit what I said earlier, is that raising a little bit of cash, it's more important. And if you have some, it's more important for psychology. And psychology is so important. Confidence is so important. And when this market gets washed out, we're going to have, if you have that cash in the sidelines, like I said, you're going to have the confidence to buy. Okay. More importantly, as the market goes up, you'll have the confidence to add, and not only have the confidence, but you'll have the money. If you don't have the money, it's hard to have the confidence, right? Because then you're like, you can't miss. And okay, I bought a little bit here and it went down. I said, I have 15% cash. Well, I put 2% of that cash into the stock, and I was wrong. Okay, that's all right. The market's down 25%. How much lower? It's not going to go down a lot more here. So I'll buy a little bit more down here. And I have that confidence. Whereas the person who has no cash or very little cash, they buy a little bit here and they're like, oh my God, it's already down. I sell, get me out. And that's the last thing you want to do.
Right. And we're getting a lot of questions here about the chat room, Matt. So I'm just going to go ahead and show this to them really quick. Someone's asking here, can you show an example of where you see the trade if you, yeah, so let me show you really quick, InvestScribe. I'm not sure if you can see that there. Matt, do you see the chat room there?
I don't. It says Benzinga has started screen sharing, but that's all it says. Oh, there we go.
Okay.
Just saw it.
All right. So basically, guys, there's one where Matt is posting Matt's important messages right there. And you can see basically where, let me just zoom in here a bit. Literally telling you the exact contract that he's buying, the exact stock that he's buying, when he's doing it, or if he's selling it, or if he's buying the puts. And then the other chat room is for all the members, including Matt, there to chop it down and pretty much talk about what's happening in the market. So you have the community aspect and you also have Matt's trades separated. So that's important. Just wanted to show you guys how that, how the trades look, right? And
Right. Yeah, and one of the things that was kind of interesting, and I'm glad we've kind of changed it. It used to be just picks, and now it's just Matt's important comments or whatever. Because there's sometimes I'll make a comment on something and not make it an official pick, and so I want to put those in there. And the reason why is just earlier this week, I was saying people were like, "Oh, J.P. Morgan, what a great company! The stock's beating up. We got to buy this thing." And I was like, "Actually, no. Again, doesn't. I mean, Jamie Dimon's." One of the most successful bankers of all time, certainly of our time and of all time. Incredibly runs a great bank. The whole bank is managed incredibly well. But I don't care how good a company is. Sometimes the stock go down. Sometimes it has nothing to do with them. Sometimes it just goes down because it got too. They're so good that the stock got too far ahead of itself and it needed to come down. But what I was talking about with J.P. Morgan, I'll pull it up right here. Hold on. Did he? Rodrigo, you let's see if I get the share back up.
yeah, go ahead, share it. I'm just going to post the
That's
link
all right.
there
I
in the
just want to
chat.
show you what I was talking about here. Whoops. See JP Morgan here and equity. So this is the stock. Okay, we're going to show you here. Okay. And I'm going to get rid of some of these. And what I was saying is, and I'm going to go right 28. Okay, so this was the stock a couple of days ago, and people were asking me, should we be buying this stock? It's down. Look at it, it's getting oversold. And I was like, yeah, but it's getting oversold because of the bond market. When again, it's important to know. You think most people think when yields are going down, that's bullish for the market. Well, usually, unless they're going down because there's a big flight to safety, because there's something going on, some sort of a crisis. In this case, it was a geopolitical crisis. So people go in and buy U.S. Treasuries because they're backed by the full faith and credit of the United States government. So that's a good place to hide for safety. The prices go up, and of course, when bond prices go up, yields go down. And when yields go down, that's negative for banks. So I was saying we got to be careful here because the situation in the Eastern Europe is not good. And if these yields go down, this stock's going to break 140. And so this is where I moved to the technical. So that was the fundamental side. Let's look at the technical side. See the stock got down to 140 right there. As it breaks, that's called a double bottom. That's important support. If it can't hold that, it's going to be a big problem. So that was on Monday. Well, sure enough, the stock got absolutely crushed the next day, and people now. And again, I did not pick it. I just said this is a good one. If you guys want to look at it, here's a good one. You want to take a chance. We call it a lottery ticket. It's one where we don't spend a lot of money, but you can get a big return. And I said, look at this one. So I didn't have it as a pick. So it didn't show up on my. So after that, I'm like, no. When I make a big call like that, even though I haven't officially picked it, I want to make sure I get that into the other room, the kind of the picks room. So that's why it calls it Matt's important calls, which may not be a specific one that I picked. And it's one example I use. I hate to admit it, but there was one a couple of weeks ago when Snapchat reported, and people asked, "What do you think about buying calls in front of their earnings?" And I was like, the stock looks ripe for a bounce. All these different reasons why it shouldn't, why people should look at the calls, and they did buy them. I said, I'm not going to choose this because I'm just a little, I'm a little nervous on this one, but it's a good setup, and if you're confident, you should go ahead and get it. Well, sure enough, the call options went up 500% after they reported they make it real. But again, so I want to make sure it's calls like that. Now, everybody knew about that because we were talking about it all afternoon long. But it's calls like that or plays like that. I don't want to use the word calls because it sounds like I'm talking about an option, but plays like that, they want to get into that other room so that people know about it. They don't have to scroll through a full day's
Yeah, and you
posts to figure out what's going on.
and you haven't what and what about that Tuesday session that you do just for the chat members? What is a
Right.
Tuesday session?
Right. Now, and what we do is we have a Zoom call, much like this one. It lasts about 20 minutes to a half an hour. And this one, I think this week, a little bit more, went over a little bit over because it was so much going on. But it's a call like this, and I pull up my Bloomberg like we have here, and we talk about things. Now, usually I've tried to do some tutorial sessions, and we have. And it's, first 5 or 10 minutes, just, and usually kind of surrounding around technical analysis, and just come over some of the basic stuff. There's a lot of good stuff in there. I mean, it's not overly basic, it's not too simpleton, but it doesn't get too extravagant. Number one, because I think most people really get too much into the technicals, and they make it more sound more complicated than it is. And so we stick to that. But the point is, I try to spend 5 or 10 minutes on that, and then we'll spend 15, 20 minutes just talking about whatever we like that week, whether some macro issues, individual picks that we're doing, whether individual stock, a group ETF or an index ETF. We're looking at those. And and then people can ask questions. We have a chat room, a separate chat room. It's not the official chat room, but it's chat on the Zoom call, and ask questions, and I respond to that. It's like a half an hour thing. Now, we haven't done many tutorials recently because there's been so much going on in the market. I think I've done the last 4 weeks. I may have done one. All the other times I say, hey, let's just get right to the market. There's so much going on, and that's what we have. But again, it's still educational, even if it's not a tutorial thing. We'll say, well, why do you like this? Why don't you like that? And we'll look at certain things. I mean, you look at I'll show you something here. Okay, NVIDIA. I mean, great company, all sorts of great prospects. Okay, but there have been several times. I'm going to get rid of some of these lines here because it gets a little busy on the chart. I got the 200-day moving average on there. That's the purple line. But look at this stock here. And I'm going to go back. And this is what's called a MACD chart. Now, people are telling me, going, how in the world could you possibly make a negative call on NVIDIA? And look at this stock. It's straight up. Everybody owns it. It's everybody's favorite stock in the area, in the chip area. Look how much it's rallied. It's up 50% in just 2 months. And it's one thing for a brand new company to be up 50%. This stock's been around for a while. I mean, and so to go up that much, it's like, what, are you out of your mind? And I go, yeah, but look at it. The stock's flattening out. And its MACD chart is rolling over. Now, what the heck's a MACD? MACD is kind of a short-term momentum play. And you've certainly heard about. I'm sure you've heard about golden crosses and death crosses. Golden cross is when the rising 50-day moving average crosses above the rising 200-day moving average. That's very bullish. Just the opposite of death cross is just the opposite. 50-day drops below the 200-day. And this is when we use the 9-day and 12-day exponential moving averages. And again, so it's a more short-term indicator. But when the 9-day crosses below the 12-day, that shows a loss of momentum. So stock's probably going down. Now, for individual stocks, it works better for some than for others. It's a very, very good indicator. But sometimes it's like 70% effective. But for this stock, very effective. And I just went back and I said, look what happened here. The stock had a negative cross, stock went down. Now, that may not because they had such a big rally, it may not look like much of a decline, but you can see, boom, that's a 15% decline. If you're buying the the put options, the stock goes down 15% in a couple of weeks, you're going to make, 60, 70, 100% or more on those options. Okay. And same thing here, had a negative cross there. Look how much the stock went down. A negative cross there. Look how much the stock went down. Negative cross, the stock went down. So I went in here and people are saying, and sure enough, the negative cross took place, even though it was a great company. And even though the rest of the stock market held up into the end of the year, this stock got hit and we made over 200% in the put options there. Same thing is happening right now. We're trying to figure out, is it now, again, see right here, it has to be a confirmed. Anytime you see in technical analysis, you need a confirmed move. If you break above a key resistance level, it has to be by more than just a couple of cents, okay, a couple of pennies. Same thing if it breaks down below a support level, has to be by more, because all sorts of head fakes all the time. In fact, some guys with their, especially in this mechanized trading, people try to get, try to push it up a little above that so they can short it and get people to get, and they short it and boom, the stock goes down. They play these games. So that's why, like, see right here, it kind of moved around sideways. It looked like it was going to break out, but it didn't. And sure enough, the stock didn't really do much. It went up for a little bit and then went back down. Right now, we're in the same kind of situation. So if this MACD cross becomes more pronounced and it breaks below its 200-day moving average and stays there, unlike these two times when it rallied back up, that's going to be really negative. If, however, it can see a pronounced positive MACD cross, and it breaks above 250, which has kind of been its very, very near-term resistance level, it's going to take off. So, we're going to wait. I'm not making that call now. I'm concerned. I'm bearish on the market here near term. But when the facts change, I change. Obviously, a lot of things can happen in Eastern Europe that would make me change my mind on a near-term basis. But on a longer-term basis, we still have problems because of what the Fed is doing. But the point is here, this is again teaching people. See right here, it looked like ooh, we're going to get a nice positive cross. The same thing here. Look at the positive crosses. Very bullish. Positive cross, bullish. Positive cross, bullish. So this MACD chart is great for NVIDIA. Okay, but again, we have to be careful because sometimes it doesn't really give us a clear signal for a little while, and that's what it's doing right now. We'll let the markets tell us what's going to happen. And that's what we play. But again, it's trying to help people understand some of these momentum things. And of course, this thing is obviously because you have moving averages crossing one another. It takes a while for it to happen. So it doesn't give you an exact top, doesn't give you an exact bottom. It tells you that a trend is change. That look like when a trend starts to change, this is something to tell you. Yep, that's confirmation the trend has changed. Or sometimes, of course, stocks can go up and pull back a little bit, and still go straight up. But when you get this MACD cross, it tells you, no, this one's for real. This one's going to pull back. And same thing here. You could have a stock that's going down. This went down for a full month, and then it got the positive cross. It didn't get the exact low. It was a couple days later, but look how much further it ran. And you can go get into the stock or buy in the call options, et cetera. And it really helps. It gives you tools. I guess the point is, far too often people are just trying to. I heard this was good. My neighbor told me he really liked the stock. It's been up a lot. I'll buy it. We used to use the tools so we can just not make guesses, but to make educated decisions. They all don't work. I mean, I guarantee you, we have losing trades all the time. I mean, but the point is, we're trying again. We want a really high batting average, which we have, and when we make them, especially with some of these options, you can really make a lot of money. And once again, we're trying to do more than just weather the storm. Now, going back to where I was kind of rambling on there a little bit, but the cash, just again, the cash thing, please, I just think it's a good idea to raise some cash. Now, what if I'm wrong? What happens if so you have 10% cash, and the market is already expensive? So is it really going to run away from us if I'm wrong? Probably not. So, but let's say it does rally another 10%. Okay, and really make another new high, et cetera. And then we realize, something, this thing in Eastern Europe is not a problem, and inflation is coming back down in a major way. So the Fed isn't going to have to raise rates. Everything's fine. So what? Oh gosh, I missed the 10% move. Actually, you didn't. You missed 10% on 10%, right? Because if you only have 10%, and people say, "Oh, you missed the whole move." It's like, well, no, I just missed. I just missed a little bit when the situation changed. So then we went right back in. I guess my point is, it's okay to be willing to miss 10% on a small portion of your assets when you go in there, and if you're right and the market gets completely washed out, and it just gives you all that confidence to step to the plate and buy stocks at fire sales. That again, that's how Warren Buffett became a billionaire. Okay, getting things at fire sales when everybody else was throwing the baby out with the bathwater. That was it. Okay. Now, before I go on to the other two, to go more details on the ETFs, leveraged ETFs, and then these options, I do want to say that again, why am I concerned about the market? And two things. Number one, we'll see what happens with what's going on in Eastern Europe. But even before then, the market was already getting up there. I just wanted to make sure I hit the top newsletters.
Really quick, Matt, just a shout out here to Gary here for joining, the newest member of Matt Maley's Inner Circle chat room. Shout out.
Great. Welcome aboard. Welcome aboard. Looking forward to having you on. Having you on. But I was just looking at the headlines to make sure I didn't miss anything since I started, because anything can happen. But the point is, Putin. I'm not a geopolitical expert, but I follow it very, very closely. I've always enjoyed that stuff anyway. I was a government major in college, believe it or not. But the point is, Putin. I mean, right now his army's standing. It's got slowed down. They don't look so good. I mean, everybody knows that they won't have any problem once they get their act together to really crush the Ukraine army, if that's what they want to do. The problem is, even if that's not what Putin wants to do, even if he just wants to, if he wants to get out of there, he can't do it now because it will look like he lost. There's no way he can do that. All right. And when Russian leaders look really weak like that, they get pushed out or worse. And so he's not doing that. Okay. And at least in my opinion. And again, I'm not just, I follow it closely, but I'm listening to some people I've known over the years and gotten to know, or people I don't necessarily know, but I know to read them. I know they're the people that are usually right. And they seem to be saying the same thing. He's going to do what he's going to do what it takes to take over Ukraine. And even if he doesn't do that, he won't back down yet. He's got to negotiate from a position of strength, not one of weakness. So that's one reason. But the other reason, and much more importantly, that even if this thing can get resolved, the markets will bounce nicely. But for how long? And again, the key is that the Fed, provided emergency levels of liquidity and stimulus never seen before ever, and that was the right thing to do. The problem is they kept providing it long after the emergency had passed. And so when, because we knew they were holding things up in an artificial way, and that we were okay with that because it was a pandemic. It was, it's like, this is ridiculous. This is not we're going to figure out how to get out of this. And so the economy completely shut down. We don't want the stock market to go down to a completely shut down market economy, because we know it won't stay shut down. So, and besides, it would cause so much turmoil. So that was right. But the problem, so then the economy started improving. So, but it could never catch up because once the emergency passed, and the thing just kept going higher and higher. It couldn't play catch up. And so now that they are getting rid of that, pulling back on that stimulus, the market has to come down. So it could be, even if the economy doesn't get worse, it's got to come back down. But more than that, one of the big things that happens is that what does it say here? Oh yeah. But one of the things that happens when the market goes up like it did last year in a straight line without any kind of corrections, people get very, very excited, and they get very, very too bullish and too confident. And they think, the Fed's got our back, there's no way the market will go down. And not only they go way out on the risk scale, but they also add a lot of leverage. And when they add a lot of leverage, you're asking for problems, because at some point that leverage has to be unwound. When you add leverage, you are skewing you're adding steroids to the supply to the demand side of the supply demand equation. So it takes the market higher than it otherwise would. When you take away the steroids, though, that leverage has to be unwound, at least to a certain degree and to a large degree. And therefore, you go a complete flip-flop. So now the supply side of the supply-demand equation becomes overbalanced. And that's why, markets, again, I'm not calling for a crash, but when markets do crash, they never crash from the top, because that's not when the margin calls come in. You don't get that forced selling. The only reason why markets crash is because of forced selling. They don't crash because of a bear market. They don't crash because of poor earnings. They crash because of forced selling, okay? And that only happens when leverage really builds up. People have leverage all the time, but if there's not a lot of leverage out there, the market really won't crash. But either way, you don't get a margin call if your stock goes down 5%. It's only after the market goes down 10, 15% or more that the people get the margin calls. And that's why the leverage, leverage, when you add all that leverage, it takes the market to an expensive level. And then but it doesn't stop at fairly valued when it comes back down because of that forced selling. It swings back to the other side of undervalued. That's how Warren Buffett became a billionaire, because he took things when it went down to the undervalued level, and we want to be able to take advantage of that. So that's why that no matter what happens with the war in Eastern Europe, As time goes on, and it will be a stair-step fashion, and it may be, back again, I'm not calling for a 50% decline, but in 2008 and in 2000, those big bear markets had 3 or 4 very, very big bounces. Okay, some as much as 15%, even more, and they can last for several weeks. And again, that's why we want to take advantage of it in both directions. And now we have the tools to do it, which we could never do. The only ones who had the tools back then were the big institutions, because they could come in and say, I want to buy a weekly option in something, and I want to put $50 million into it. And the bank would would basically concoct an over-the-counter option to do that. But if somebody went in and said, I've got, $1,000 to do that with, they go, no, that's not. It's not worth it for us to do it. We won't make any money on that. It's not worth doing. And so they wouldn't do it. It was only for the big institutions. Now the mechanisms are there with all the weekly ETFs, weekly options, inverse ETFs, leveraged ETFs, et cetera. But the point is that no matter what is happening here, again, I just want to go back to my other presentation here, and I would show you this one that I was talking about before, or I showed before. But again, here is the situation. Margin debt, that is a real good key indicator for how much leverage there is in the marketplace. And look, again, the addition of leverage, people say, oh my gosh, there's so much leverage in the, well, that's a lousy timing tool. It's only when it turns down that it becomes a problem, because then you get margin calls and such. So here we got leverage way up. That was, of course, 2000, the high in 2007. 2018, that wasn't a bad bear market, but it was basically a 20% decline, 19.8% decline in the S&P. Now we have the same thing, much higher leverage than either of those 2 times, and it's just starting to roll over now. And this is just barely into the first of the year. So the stock market's going to be coming down as this leverage gets unwound. And that's why we need to be careful here. And that's why it's so great that we have the tools now to work both sides of the play. And again, just because I think the market's going lower doesn't mean we're not going to be, as I just showed you earlier, is that we made money. We made 390% on the puts, and we made 320% on the calls on the way back up. We want to be doing that on both directions, because like I said, in the worst bear markets, and we've had 2 of them, 2 of the worst in the last 25 years, last 22 years, 2 of those worst bear, we still had big rallies. And of course, as we learned during the in earnings season, individual stocks can see unbelievable moves when they report earnings. The market could be rallying and the stock could drop 15, 20%. The market could be selling off and the stock could rally 50% like Snapchat did. So again, this is the type of stuff that we're really pushing hard to capture and take advantage of with a little bit more active trading. Let me exit this again. Go back to my Bloomberg. Oops. There we go. Whoops, that's not what I wanted. There we go. Okay, now, so let's go back to just a couple things we're going to talk about with the ETFs. Now, and most of you are very familiar with the ETFs, and again, they're not just for the indexes like the S&P 500 or the NASDAQ. By the way, the NASDAQ is not the NASDAQ composite. The QQQs are for the NASDAQ 100, so they're even more leveraged to not leveraged, but more weighted to the big technology names. And that's why I really like to trade them right now, because those are the biggest movers in both directions. But the point is, we also have ones on individual stocks, individual groups, whether it be the KBE Bank ETF, the XLE Energy ETF, the XOP Oil and Gas ETF, the XLI Industrial ETF, the SMH Semiconductor Stock ETF, on and on and on. The IBB, which is biotechs. We made some really nice moves on the LABU, which was the bullish, 3 times bullish ETF for the biotech stocks. And about 2 or 3 weeks ago, we went into those and bought some calls on that. And people, again, making 50, 100% or more in just a few days. And these are the types of situations that we're looking for when we get, the key is to get the key things at key turning points. It's one of the things I've been very, very good at. Whether it be on a longer term basis, like I did when I turned really bullish on the oil stocks in October of 2020. And of course, they've huge around the rest of Wall Street didn't turn bullish. I mean, they didn't start turning bullish until 3 months later. And they had a great year in 2021, and they're high-fiving each other. Well, that's great, but they missed half of the move, half. They were 50%, that we were up over 100% in the XLE and the XOP because we were much, much earlier. We saw that big change in trend early. Now, we can't get the exact bottom. Nobody ever can. But when you catch it, those guys are looking for the 70% in the middle. We're looking for the 90 to 95%. And when you combine not just the fundamentals, but also the technicals and the positioning and the sentiment, you can really get that kind of movement. Okay, so to get going, but the one thing I really want to talk about are these leveraged ETFs. Now, we use them quite a bit. People, again, sometimes, especially when the VIX gets really high, and therefore the options can get very expensive. When the market's really volatile, they become more expensive. So you can just go buy these. This is the SQQQ. This is the 3 times leveraged bearish ETF. See how this has rallied a couple times. You see very, very strongly. It makes some real nice plays there. Okay, a little less risk than the options because they don't expire. There's no expiration date. However, there's also so more risk but more reward, and because you're getting 3 times the movement of the S&P. There's also the TQQQ, which is the 3 times regular way from, I'm sorry, yeah, TQQ. So in other words, you get it's 3 times the regular QQQ. So it's when the QQ goes up 5%, this will go up 15%. However, very, very important. Whether you ever come to our chat room and listen to what we're talking about on a regular basis, be very, very. These are trading tools. The inverse ETFs or the regular ETFs, if they're fine. I mean, there's no problem. Okay. You are the SH, which is the short S&P. If the S&P goes down 5%, the SH will go down 5%, and that's fine. Okay, but you don't but when you get the leveraged one, let's say the market goes sideways. Well, the QQQ, it's just going to go sideways, right? If the Nasdaq goes sideways, it goes sideways. If the market goes sideways and you own one of these leveraged ETFs, they will go down. Whether you have the bullish one or bearish one, doesn't matter. They're like options. They go sideways, they go down because they use options and futures to get that leverage. So be very, very careful. If you think that the NASDAQ is going to crash and go down a total of 50%, you don't just sit there in the SQQQ because it will bounce, because it will lose value over time unless it's going down every single day. So it's a trading tool to go in and out. I never go usually not more than a week, and certainly not more than 2 weeks, and many times just for a couple of days. But again, if the market goes sideways, all of these leveraged ETFs in either direction will go down. They will not trade sideways. Now, the regular ETFs will trade sideways, but the leveraged ones will not. So be very, very careful. They're trading tools, not long-term vehicles, and not even intermediate-term vehicles. They're a week, maybe 2 at the most. It's so important to understand. But again, these things we have them for basically every single group, and we have them for, like I said, for subgroups, like not just for the XLK technology ETF, but we have them for the SMH, for the semiconductors, and you even have them for you can go into the technology, into the transportation, but you can have some for the truckers and the rail stocks. Those aren't as liquid, but there are many of them that are very, very liquid. And then of course you have the consumer staples, which is the consumer discretionary stock, XLY, incredibly liquid. But you also have the XRT, which is the ETF for the retail stocks. So we have all these different tools we can use, and they all have inverse ETFs, and most of them have leveraged ETFs. And again, we can move them both ways. So, but I guess on that one thing, I just want to say how important it is to know that those leveraged ETFs are trading tools, not long-term plays. The last thing, of course, the options. We've been talking about that for a while now. And it's since we started here, that's kind of been a key thrust of what we've been doing, and we've been it's where the biggest money is. But sometimes it's boy, I tell you, sometimes people are asking me, should I do this, should I do that, and I'm like going, I don't see anything compelling right now. Let's just hold off. I mean, sometimes the right thing to do is nothing. And that's hard to do sometimes, especially when the markets are bouncing around a lot, and you're going to miss opportunities. But that's okay, especially in today's market. There's so many different opportunities: individual stocks, ETFs, options, etc. There's so many opportunities. You miss one, don't worry. We'll go on to the next one. And that's same thing with cutting losses too. Cut your losses early, get out, move on to the next one. but we really want to, I just want to emphasize how this is something that, let's just look at the QQQ. Equity RSI. Oops. Let's say, so the QQQ has traded 69 million shares today. So I think we'd all agree that's plenty of liquidity. Look at the options, okay? Look at these options today. 12,000 contracts, 20,000 contracts, 25,000 contracts, 70,000 contracts. Here over here in the puts, same thing. 90,000 contracts, 26,000 contracts, 47,000 contracts. SPY. These are the the SPY. This thing traded. Okay, that only traded 104 million shares today. Okay, so if that's not liquidity for you, you're richer than you shouldn't be on this call, because you can just burn cash. And look at the options on this one. These are the volume. I'm just talking about the volume on these today. Look at these. Okay, 130,000 options is the volume today. 104,000, 260,000. 59,000, 120,000, 264,000. You have plenty. And then guess what? If you don't like those, because they expire on Friday, well, let's go down to the ones that expire on Monday. Well, 15,000, 14,000, 11,000, 29,000, 24,000. Huge volume. Oh, you want to go out further than that? You want to go out to next Friday? Okay. 22,000, 10,000. Again, as the further you go out, the volume dries up a little bit, but it's not like they're it's if you want to 22,000 contracts, again, if that's not enough liquidity for you, you're really doing well. So these are the types of things. Then we look at Apple Computer, individual stocks. Okay, now of course Apple's going to be more liquid than others, but look at these options. Okay, you don't have to go out and buy the June options. I mean, look at these things. These things are 117,000 contracts, 230,000 contracts. Okay, you go out a week, you go out 2 weeks, 48. Oh, sorry, that's the open interest. But see, 33,000 contracts. There's plenty of liquidity, and so you don't have to worry. And look at the spreads. 20. Well, these are because the market's closed. They're wider than they're usually about 5 cents. So you don't have to pay way up, pay way down. The opportunities are there. The liquidity is there. The tools are there to take advantage of it. So that's really what we're looking at right now. And again, what you'll find with me on the chat room and anything else, is I'll tell you like it is. I mean, we have people that if you see me on CNBC, I'm actually, if you're in Asia, I'll be on CNBC Asia tonight at about 2 hours. I'll be on talking about things, but a lot of the people on CNBC, who come on from different firms, and they're kind of, they're paid to be bullish. That's their job. I mean, if you are a car salesman, you don't particularly like one brand, you're still going to sell it, right? You're still going to portray it the best way you can. I'm sorry to say that's what these people do. That's what they're paid to do. Now, they're not saying that they're doing anything wrong. They're saying buy on weakness, good opportunity. The market usually does go up, okay? And so they're not, they are very accurate. And I just want to show you one thing that I do like to put up all the time. Oops. And, the market does go up. I mean, inflation, et cetera. There's a reason for it, okay? And let's go, 1992. So we're going back the last 30 years, okay? Last 30 years, the S&P, bang, bang, boom. There you go. Okay, it's up over 1,000%, right? Up over 1,000%. Remember this bear market? 55% decline, over a 50% decline, huge declines. And yet the market kept going higher and going much higher. And of course, I can go back much further and go back to 1970. And it's funny, the greatest crash in the world of all time, this little blip, this little thing was the scariest day in the history of the stock market. When the market went down more in one day than it did in 1929. And yet it's just a little blip on the radar screen. Look how much the market has gone up. So the thing is, though, we want to be able to take advantage of when we get these rougher times. The same thing, but again, I want to talk about. Here it was, the great bear market when the bond bubble burst. Look at these big rallies. Big one there. This one may not look like a big one, but this one right here, boom, Thank you very much. That's 8 to 10%. If you're buying index options in there, but you think when this went up 8%, how much do you think Apple rallied? Probably about 15, 20%. You buy the call options in Apple, then you're up 100%. Again, this is a 15% rise. All these, even though the market was getting crushed, we saw some very sharp bounces. We want to be able to take advantage of those. And even, and we have the tools again. But these tools don't just work to the downside. They work to the upside too. And again, these guys were making money, really astute traders, but they would still not as much as they make today because they didn't have weekly options back then. Right? And they didn't have index options that expired 3 times a week. Now they didn't have ETFs, et cetera. But you go down and we're just going to go for, whoops. 99. Okay, so that was what happened in that bear market. We saw the same thing here, right? Again, these are 2 horrible bear markets, but we see these big rallies, okay? And again, they may not look like much, but boom. Thank you very much. Nice 12% rally. So we want to take advantage of both sides. Now, you say, well, that only happens in really, really bad bear markets. Well, actually, that's not the case. We had that deep correction back in 2018 when the market went down 20%. See that? Big bounce there, nice little bounce there, nice big bounce there. And again, before the big sell-off came along. And the reason why that happens, of course, is that and what happened in 2020 was very different. Why? Because everybody turned bearish all at once. And for the right reason. They're like, oh my gosh, the whole economy is going to shut down. Okay. Where usually, and this is, oh my God, it's shutting down. Get me out, sell. And not only that, even if those who people didn't sell, nobody was buying. It's like, I'm not buying anything. So it didn't take much for to knock down the market. Most times, though, what happens, and what's happening now is that people keep wanting to believe, oh, the worst is over, the worst is over, the worst is over. And so they come in and buy, the market bounces. And it takes a couple of big sell-offs to finally convince people that the market needs to come down. It got too expensive. Now, in some cases, in the past, it's like, okay, the market has become, the economy is about to roll over, so the stock market's about to roll over. This time, like it was after the tech bubble, it's really that because we were on steroids and went too high, it has to come back down. No matter what the economy does, stock market has to come back down. If the economy comes down, even worse. But in this case, I guess my point is that the stock market coming down isn't an economic event like it usually is. This one is just more of just when the market's trading at 22 times earnings, it's just way ahead of itself because it was on steroids. I don't care. You could be the strongest guy in the world. If you go on steroids, you're going to be much stronger. And when you come off it, you'll still be strong because you were a strong guy to begin with, but you're going to be weaker and you're not going to be able to hold up as much weight. That's the same thing with the stock market. It's going to have to come back down, but it's not going to come down a straight line. And we have now the ability to profit from that volatility that exists in the marketplace right now, and we want to do it. So I guess my point is there's a lot of opportunities to do just as well as we did last year, maybe even better in certain cases than it did last year, buying some meme stocks and things like that. Because there's going to be more stocks going to be involved. I mean, those meme stocks, you have a handful of stocks on any given day. Here we've got big moves in hundreds of stocks, if not thousands, hundreds of stocks moving big time every day. All these ETFs moving big time each day, and the broad market seeing big wild moves. Unlike we saw last year, when the market only moved, even though it was a nice steady rise, it wasn't the big volatility. So that's really what we're trying to accomplish here with this with the site and again with the chat room. Now the other thing too is to go back, and people are asking. I put up this earlier. Ford Motor Company. Now, person came in today, and I missed the question. They asked, "What do you think of Ford Motor?" I own the May calls. I won't go into more details on that, but these some calls that expire in May. What do you think? And so, and that was the same thing. And he realized I had not answered the question, so he asked it again. I try to scroll up and down, get them all, but I can't. I get off. I go on TV interviews, I have meetings and stuff like that. But I'm on that chat all day long, and I try to get everything. And if I don't, just ask the question again. And that's what we do. And that's what happened today. Now, so I said, "What do you think of Ford here?" Now, anything could happen. They could start a major bombing thing in Russia tomorrow, and of course the stock will go, the whole market will go down, and Ford will go down with it. But I said, look at this thing. Look at, again, we're talking about, I showed you earlier about the MACD chart. Well, we look at the relative strength index as well. This is the RSI chart, and you see when a stock gets down here down near 30, relative strength index, it's the line is green. That means buy. Yeah, go ahead, buy. When it gets above the red line, above 70, it means sell. Stop buying, sell. Okay. Well, it's getting overbought here. Got overbought. It also got down to its 200-day moving average. See how the 200-day moving average provided very good support here? It got down last week when the whole market flushed lower. It got down, but it didn't close. You can't, it's hard to tell there. Let me show here. Let me zoom it in a little bit. But this line, that little flag there, that's where it opened. The flag on the right is where it closed. Every single day has that. You see it dip below, but it closed back above that line. So it held that line. Here on the other day, just on Tuesday, it got a little below the line, but again, held it again. Okay. Now we have a situation. So what's happening? It's coming off an oversold condition. The last 2 days, it got up to $12.25. So 12.25, just to make sure I have that right. Yeah, $12.25. Okay. And stopped it. That's just 2 days in a row. So it's not major resistance, but let's add one more thing on here. I talked to you about the MACD chart earlier. It's just starting to see a positive MACD cross, right? See the MACD cross there? Look what the stock did. See the MACD cross here? Look what the stock did. It's not quite there. It's not, like I said earlier, it's not a major breakout yet, not confirmed, but boy, it's getting there. And if this thing can break above 1825, this MACD chart is going to see a more compelling cross, and the stock's going to run. So I said, hey, listen, you got to be careful because if we get some really bad news, you might want to exit the trade. But right now, the odds are really good. You're coming off an oversold condition. You're getting a positive MACD cross. You're up against, if this thing can just break up, and again, that's very close to where it was here. You see this kind of, and I'm not going to draw it out, but it could even, I didn't even mention it either. It could also be seen as an inverse head and shoulders pattern. I won't go into that, but and if so, I'll draw it up for you while we're here. Why not? Okay, look at this thing. It's kind of okay. See, all right. Geez, I wish I had mentioned this to him, but I didn't notice it. But the point is, these are the things we're talking about all the time. It doesn't have to be one of my ideas. Well, geez, I've got a thing. What do you think? Should I buy it? Should I sell it? What should I do here? And so you see, it's a little bit of a stretch to say it, but here's the left shoulder, there's the head, there's the right shoulder. It breaks above a little bit, again, above that 1825 level, it's going to run. So you have a lot of different reasons why this stock looks pretty good on the charts. But of course, there's always a caveat. Nothing's perfect when it comes to technical analysis or anything else in the stock market. The only thing that's perfect is inside information, and you don't want to be using that because you go to jail. And so if I had, I wouldn't use inside information. I never have, never will. If I had it, I wouldn't give it to you. So and I wouldn't act on it for myself. But the point is that these are the types of things. And again, I said, usually I'd be saying, hey, this thing breaks above 1825. You got to buy it with both hands. I'm not saying that now. Not only should you hold on to those calls that you own, you ought to buy more. I'm not saying that now because of the risk involved in the broad market. But overall, again, that just goes back to what I was saying, what we're trying to do in the, and I'm getting all sorts of messages here. It's always great. Deutsche Bank down 6% in the last 5 days. Ooh, Deutsche Bank down 33% in 1 month. So that's not good. It's just a colleague of mine telling me a message there. That is okay. So yeah, just talking about what we do in the chat room. We're not just talking about my ideas. We're not talking about what think. We're also people talking about what like this. Remember, I told you about what happened with that Microvision, the stock with the lidar and the display for smart glasses. Ford Motor, and there's stocks. I mean, a couple of stocks. I was like, I've heard of that stock. They say, well, what do you think of this stock? And I'll say, well, I'm thinking about buying calls that expire Friday. I'm like, well, I don't know the company, and so I'll be honest. I'm I could go and sit there and look it up on the internet, but that doesn't. If I know it, I know it. If I don't, I don't. I mean, it's not. You know, you can look it up on the internet. Why do you need me to just regurgitate what's on the internet? So I'm not going to waste your time with that, and I'm not going to admit. I'm not going to. So if I don't know it, I don't know it. I'm not going to lie to you. But I'll say, hey, listen, I don't know this company, but look at this and look at this on the chart, and that's all I can tell you. I can't tell you anything more. But the point is, it doesn't have to be something we're talking about. It'd be something hey, your next door neighbor works for a company. It looks like he tells me their business is doing really well. What do you think? And if I know the company, I'll tell you this, yeah, this, and that. And then look at the chart, look at the sentiment. And the thing is that one of the things I'm going to go back on this a little bit. This whole thing about sentiment and positioning. And one of the reasons, and this is good because I want to talk about the oil stocks right now. The sentiment, I'm sorry, back in October of 2020, so about 16, 18 months ago, everybody hated the energy stocks. They said fossil fuels, forget it. They're dead, dying industry, not a chance. And I was like, fundamentally, that's just wrong. I mean, I want it to be right, but I know from all this work I've done, there's no way we're going away from fossil fuels anytime in the next 2 decades. Certainly not in the next decade. And the IEA, International Energy Association, is saying the demand for fossil fuels at the end of this decade is going to be 95%, okay, of what it was pre-pandemic. In other words, it's only going to go down 5% by the end, because the technology isn't there to go away from fossil fuels. It's just a fact. I mean, maybe something will change and we'll be able to speed that up. But right now, they can speed it up a little bit, but they can speed it up a lot unless some new technology comes out. Maybe they'll come. But that was my point. It's like the fundamentals are still strong for this. Number one. Number two, sentiment. Everybody hated the groups. I mean, forget it, fossil fuels. And I'm like pounding the table. No, you got to buy these. You're crazy, Maley. You know what you're talking about. Positioning, okay? Mutual funds were the lowest exposure in that group ever. So nobody owned these things. And then everybody was short them. You look at the futures positions. Everybody, the futures traders were all short them. Everybody was on one side of the boat. It only had one way to go. It could only go out higher. And people are telling me I was nuts. I was like, and not only that, I said, wait till this thing starts going. Then all these institutions are going to have to buy it because it's going to be the best performer. And sure enough, that's what it was last year. And people went jumping in. I mean, these stocks doubled. These are energy stocks. These are not technology stocks. But that's the type of thing we're constantly looking at. If you're only looking at fundamentals, especially in a volatile marketplace, you're going to get creamed because the market. They always say the market's always right. The market is only always right eventually. Okay. Sometimes the stock get way ahead of itself because people are getting too enthusiastic. Sometimes, like it was with the energy stocks, they get way too bearish and they throw the baby out with the bathwater. Or sometimes it gets thrown out because of forced selling, margin calls, and such. It creates unbelievable opportunities, and now we have the tools to take advantage of those. And that's what we're trying to do in this in the chat room. So that's really kind of what we're doing. Rodrigo, if you're there, if you want to talk about some specific names, we'll talk about. I'm going to first of all talk about. I know some that are favorites of everybody. Tesla, but I like to get when Rodrigo gets back on, we're going to have him talk about. Have you guys feed some tickers to me that I can go over on. And again, don't have to be specific stocks. They can be on sectors and such.
Before just let me know.
Before we go on to Tesla here, I want to talk about the bank stocks. Okay. I'm sorry, the bank stocks. I want to talk about the energy stocks. As I said, I love them and I still love them. However, one of the things I have right now are some put options on Chevron that expire next week. Now, and the reason is this is not a call that I'm saying, it's not a play I'm saying will definitely happen. But it's one where we have a bunch of negative positions in the stock market because I'm worried we'll go down. Oops. No, well, look at that on that. But what I'm worried about, okay, is that the okay, one second. I'm sorry, I just want to get this chart set up for you so you can see it well. But what I'm worried about is that this thing has gotten ridiculously overbought on a technical basis. So if we get any kind of bullish news out of Eastern Europe or from Iran, there's also some rumors about they're going to have an agreement with Iran. but that's, that is, this thing is just going to implode. So I'm kind of taking a more of a lottery ticket, but let's go. Okay. Yeah. What the heck? Okay, whatever. Okay, but so we can see here, I'm going to pull this up. See okay, I'm sorry. Give me 1 second here. I just want to get this other trade up here. It's called the Bollinger Bands chart. Okay, now, all right. Now, what we have here, remember I talked about the RSI, the Relative Strength Index. Okay, and this is just on crude oil. Of course, we all know it's right, but look how high that got up. That got up to 79. It actually got over 80 intraday yesterday. That's just as overbought as it was right here, just before it started to roll over. Also, the Bollinger Bands chart. Again, if you're not familiar with them, it's an educational thing. That's what we're hopefully trying to help people. This is this little line in the middle here, this kind of greenish, grayish line. That's the 20-day moving average. Okay, I think it's 20-day exponential moving average. Okay, this purple line is 2 standard deviations above that line. The yellow greenish line is 2 standard deviations below that line. When it gets above that, more than 2 standard deviations, it gets way ahead of itself. That means it's overbought. So we have an overbought RSI and extremely extended above its, way more than close to 3 standard deviations are way above its 20-day moving average. And you can see what happened here. It got just a little bit above it and then sold off. Right here, it just got up to that line and sold off. Here, here it got slightly above it, sold off for a couple of days. Now it's extreme. Now there's a good reason why it's extremely above it, because we have geopolitical situation. If it wasn't for the geopolitical situation, I'd be saying mortgage your house and buy put options in energy stocks, because they're all going to come. They're just way too overbought. That's not the case now. They wouldn't be this overbought if it wasn't for the geopolitical situation. So it's understandable, but we want to be able to take advantage of it. And if we see any kind of weakness in oil, I'm going to get even more so, because again, and you look at Chevron, which some of the put options that we own, see how overbought this was. This stock, again, look how overbought that stock is. I'm going to get rid of the moving averages. I'm going to put that Bollinger Bands chart up there again. Oops. I need that, I need. But you're an active trader. We want to be looking at things like this all the time, rather than just trying to guess. Oh, is Putin gonna? Is somebody gonna? His own general's gonna take overthrow him, or are they? You're just guessing. I'm not guessing there. You're making an educated guess that this thing could go down. There's a lot of reasons why it won't, so you don't want to bet the farm on it, but you can make a little bit of a bet. See how overbought that was? That RSI, if you look back at these other times, it's more expensive than been a long, long time, and it's way above its 2 standard deviations chart, and those Bollinger Bands chart. So these are the types of things we talk about. So that's why I was just saying, even though I was pounding the table on the energy stocks, I have a short. I mean, I don't want to make. I'm not taking profits on the energy stocks we own, because I like them longer term. I like them intermediate term. So we're not taking profits, but I'm trying to take advantage of it here, so that maybe we can make a little bit of money if and when it comes down, because we own the stock. Gosh, we own the stock way back. Well, go back and further. 2020, we bought the stock in our tier 1 trade way back here in October, right in here. Okay, so this stock was 80. The stock's doubled since then. So if it comes down, when oil comes down, so it goes down to 140. What do I care? I own it at 80. Well, I'm not going to worry about that. But on a short-term basis, maybe we can make some money on that trading account, the more active trading account. But this is so again, I just want to acknowledge, because I was pounding the table so much on oil, I don't want people to come on saying, oh, geez, that Maley loves oil stocks. I'm going to buy them here today. I would avoid them right now. And again, I'm not making a big bet on the negative side. It's a very small bet. But I do think there will be another opportunity before long for these stocks to come back in, because let's face it, oil, back in 1991, the oil market, the stock market went down because everybody's afraid of the Gulf War. Oil skyrocketed. As soon as the shooting started, oil dropped 40%. Oil's not going to drop 40% this time. Okay, it may drop down to 90 bucks, but it's not dropping down by 40%. It's not dropping down to 60, okay? Because it was already up for other reasons. Back in 1991, the only reason it was up was because of oil. Okay, that's the only reason why the stock market was down. This time around, the stock market was already down because of what's going on with the Fed and other global central banks, and oil was already up because of the whole supply demand situation, and we just don't have the ability to meet demand right now. And even if the oil starts flowing once again, it's not going to be there. It's going to at most it's going to drop to about 80 bucks. That's still very, very profitable for the energy companies, and so I like the group, but I want to take advantage of it. Anyway, so I'm sorry to go on that, but Rodrigo, if you want to ask for some tickers from people, but while we're doing that, I might as well look at Tesla here, because I know everybody likes Tesla. Everyone's interested in Tesla. But you can see here the stock, it's made, wasn't it? He was for, again, I mean, it was funny because when he announced he was going to sell stock of Elon Musk, again, these, I kept saying these people, I was like, he's selling stock for a reason. He is selling stock for a reason. And no, he has to sell it. I go, no, he doesn't have to sell it. He has to sell it by August, okay, of next year, okay? He's got plenty of time. So if he thinks his stock's going higher, he's not going to sell now. He may not wait until August. He's not selling now, because he had these stocks, versus for some compensation. He had all these options that are going to expire. So he chose to sell these now for a reason. Now, part of it he wanted to sell before the end of the year in case the tax went up. But also, I just felt he saw what the Fed was doing, and he knew that the stock was expensive. Okay, it doesn't mean there's anything wrong with the company. It doesn't mean that he's worried about the company. It has nothing to do with that. This has to do with the fact that the Fed is going to go from incredibly accommodative stance to one where they're going to be tightening. That means leverage has to come out. There's a lot of leverage in this stock. He made the sale. Okay, insider. Microsoft. Great CEO, Mr. Nadella. He's done really well. He sold, $270 billion, $270 million worth of stock right here at the top. He's an incredible CEO. His company is a great company. His company will continue to be a great company. For him selling, absolutely nothing wrong ethically with it. He just saw the stock had gotten too far ahead of it. People don't sell 2/3 of their holding of their company they run unless they think the stock is not going to come back to that level for a couple of years. Doesn't mean it's going to go down for 2 or 3 years, but it's going to go down. It's going to have a tough time coming back because he knows that the Fed's liquidity took it higher than it should have. It's just my opinion, but again, people have heard me tell this a million times in the past. Goldman Sachs, all their partners sold stock in 1999. The market crashed in 2000. Blackstone, the biggest PE private equity firm, they sold their stock to the public in 2007. 3 months later, the market topped. Glencore, one of the biggest commodity traders in the world, they sold their stock to the public in 2011. 2 months later, they began an 8-month bear market, 8-year bear market. When they see there's nothing wrong with what they did. They didn't push. Again, if they lie and tell you that things are better than they are, that's one thing. We saw what happened with Enron. They're complete liars. They went to jail. People like Nadella, he's a great CEO, a great businessman, but he just did the smart thing. But people don't do these things. Elon Musk doesn't sell that kind of stock when he's got more time if he thinks the stock's going to go higher. And sure enough, he's done very, very well. Anyway, I kind of got long-winded there. But that was I'm going to go back to Tesla. Again, this has nothing to do with this company. The stock could go a lot higher over time. And I said the stock could go down below 1,000. There were some people in the chat room told me I was nuts. And I said, could even test this 200-day moving average. And one guy stopped. I think he left the chat room because I've heard from him since. But the point is, I was like, I'm not saying anything wrong with it. I'm not saying, he kept saying, this guy's the brilliant, smartest guy in the world. I made so much money with him. I'm like, that's great. That's great. And you will continue to make money with him. But the stock's going to come down. And it did. And even went below its 200-day moving average. So what are we looking at right now? The stock right now, short term, you can see how it got up just below 900. So about 890 each of the last 3 days. And it stopped right at that level. So we want to be, if you're looking to trade the stock on a short-term basis, it can finally break above $890 and really above 900. It should run nicely. And because also here, because it got down to its 200-day moving average, if it can bounce off that this time, see how it bounced off it there? It obviously got knocked down below it here, but only for a couple of days. And it was only because the rest of the market really got crushed. This is going to be very bullish. On the flip side, if it breaks below that 200-day moving average, boom, 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 which is 838, you know, it ain't kind of meaningful way. Again, if it goes to 837.90, that's not a problem. But if it gets below that, it's going to be a problem because you see we've had a series of higher, lower high, lower low, lower high, lower low, lower high. This thing could go back down and even test that 700 level. That's not my base case, but it's something I'm thinking about and worried about. So be cautious on this one. That said, but you be nimble. Be nimble. This thing breaks again. If it breaks above $890, this thing is going to run till the daddy takes the T-bird away. I just want to look at one other thing here. MACD chart probably rolling over a little bit, but it's not. Yeah, it's been kind of playing around there, so we won't really care about that right now. But again, those are the levels to watch: the 200-day moving average at 838 and the 890 level on Tesla. So, Rodrigo, are you there?
Yeah, just waiting on the queue here. Let me know when. Okay,
Yeah,
we got Luther the champ from the Zoom chat asking for Shopify.
Okay, let's see here. Shopify. Okay. All right. Now, this is one of the things that we want to talk about, which is good. What happens if this market really gets washed out? I talked about the leverage and things like that, and that gets unwound, it really gets ugly. You know, if and when that happens, you really, you know, obviously want to be looking at some of these great companies like Nvidia, like Amazon, like Apple, etc. However, you have to remember that they are kind of a flight to safety trade now, and they're holding up much better than some of the other names. But if the market really gets ugly, then they become sources of cash. If people have obscure, especially if it may even be in the bond market, some obscure things they have to sell, and they're getting a margin call, and suddenly there's no bids in that asset, they've got to sell what they can, and they're going to sell the Apple computers, and they're going to sell. And so when it gets washed out, they might actually do worse than you might think. So they'll be ones to buy, but also look at a stock like this, Shopify. Okay, this stock's already washed out. Okay, stock's down more than 50%. The margin calls have already taken place. The stock's already sold out. Let's look at its weekly RSI chart. Boom. See how oversold it is in its weekly chart? Okay, it can get back above its 200-week moving average. That's going to be bullish. So I guess my point is, like anything else, it's been hit so hard. If the rest of the market, again, I'm bearish on the rest of the market, so I don't want to jump in with both feet, but this is not a bad stock to nibble on because its downside is actually going to be less than you might think. Because you might think, oh my gosh, this market gets washed out, these lousy stocks are going to get crushed. Well, yeah, for some of them that don't make money at all. But if you believe in a Shopify, and this is one that's actually going to do okay. But again, it's made a series of lower highs and lower lows. That's scary. That's what I'm looking for here is the 200-week moving average at $701. You break above that, that's going to be quite bullish for the stock. So, but this gave me the opportunity to talk about a situation where you want to, everything kind of reverses. It's kind of like with, negative interest rates are usually bullish. I'm sorry, not negative interest rates, but lower interest rates are usually bullish. But when it's a flight to safety, it completely flips. Same thing happens with some of these underperformers. When they get washed out first, they're actually the ones that are going to do better in the rebound and aren't going to get as much selling. And even though that's kind of counterintuitive, it's actually what happens. Now, look at Facebook, Meta. Okay, look at this stuff. It's been absolutely crushed, and this stuff, they ain't going out of business. Okay, this market gets washed out. This stock gets back down in here, man. You want to be buying this stock. It's got long-term prospects are unbelievable. Personally, I think they're kind of doing this to themselves purposely because they know they're going to have to do it anyway. And if the stock's flat and it's back, and these guys say, "Oh, I've lost all this money," they'll be able to. I say they'll be able to claim poor, but they'll be able to they won't be flying high, and that's what they want to do. When they get the actual restrictions put on them, they want to be have been slapped around already a little bit, because then the people aren't the people aren't out there with the public isn't out there with their pitchforks to burn them at the stake. I think it's just human nature. I know that might sound crazy, but either way, it doesn't matter. My point is that this stock is incredibly oversold. And it's not bouncing at all. It's probably dead money for most of the rest of this year, but its downside is going to be limited. Boy, you ought to buy this stock every month. Just buy it. Buy some. Just buy some every month. And when it gets hit, then you back up the truck, because 2 years from now, you're going to be sitting real pretty. This stock is a great stock. Anyway, I kind of got away from Shopify, but that's what I'm looking at right now.
Okay, and then we have, and just for clarification, folks, Matt will be following up if there's a trade to be made. He'll be following up in the chat room. For example, if there's a trade to be made either in Shopify or any of the stocks that we've been talking about, that's where he follows up. So the chat members know what's up. Then we got PLTR, Matt.
Okay. Okay, now here's the one again, same type of thing. Gotten what kicked out of it. So the leverage in this thing is not very high. Let's look at is not probably non-existent right now. Short interest is very high. Okay, see that's the short interest here. So at some point when this stock rallies, the shorts are going to get squeezed. But let's also look at.
Because people have been asking about PLTR for years, and they just keep asking about it. And I mean, it's a legit company, right?
Oh,
I mean,
absolutely,
you looked into
absolutely. And you got to look, see, and again, I'm just looking at the MACD chart. It did make a positive cross. It looks like it's trying to curl back over, but again, lower high, lower low, lower high, lower, just kind of straight down, lower low, lower high, lower low, lower high. We want to see that change. So we're not going to be fully. I'm going to do the stock on the. If this again, this is what we want to do here in this stock. You want to start nibbling here at this one. Get a little bit more aggressive at if it gets down here, down to its old lows. Again, if the whole market gets washed out. But then you want to look at this. This is so important. Okay, $14.17. That was a high, whatever it is. It's 14.20. See how that if it gets above that, it's going to move. Sorry, gets above that level. It's going to be a key higher high, the first higher high since God was a child. It's going to take it above its trend line going back to November. Okay, the MACD chart's certainly going to turn up. So, okay, what do? So you buy a little bit now at 11. Then maybe you buy a little bit more at 10. So now your average. Now it starts to go up. I say, starts to go up. And it breaks that 14.20 level. What are you going to do? Okay. Oh, I'm just going to let it run. No, buy more. This is a breakout. You buy more. What gets to 15? So, okay, wait a minute. So I bought a little bit here, I bought a little bit there. My average price, is $12, is $11. Okay. At 12, let's say $12. 11. Say my average, whatever, $11. So why don't you double up at 15? You double up at 15. Well, yeah. Instead of kicking yourself for not buying more at the lower level, go ahead. So now you're 11, 15. Now your average price is 13. Okay. Your average price is 13 and the stock's trading. You're adding to a winning trade. Okay. And now okay, my cost is 13. That's where I put my stop. I can't lose money. Well, it could gap opening on some real bad news, I suppose. A good bad go gap down. But unless that happens, I'm just gonna have a stop level at 13. I'm guaranteed not to lose money. It keeps trading up. I buy a little bit more. Now my average price is 15. Okay, now I stop buying it. I'm just gonna let it run. It goes to 20. My average price is 15. Okay, and it keeps going. Well, now I'll raise my stop out level. Now I'm guaranteeing myself a profit. So when the stock's at 20, my cost is 15. I'm going to raise my stop to 18. And whatever, you can decide fundamentally, whatever, and just keep letting it run. That's how you're able to let it run with confidence, and it's like, okay, it gets down, I'm out, and it may come back down. You can go back into the stock, whatever. But these are the types of things, especially with what I think is coming this year, when we see a deeper correction and the market's down 20 or 25%, you're going to get stocks like these that are really washed out, good companies. Same thing with Facebook. Don't be afraid to add to them as they move up. I mean, Will Danoff may be the best portfolio manager in the history of mutual funds, even better than Peter Lynch. Well, I would say better. It doesn't matter. They're both Babe Ruth. What's the difference? But he's over Fidelity. You know, he adds to his favorite stocks every day, and he's been buying apples for years. Well, again, he has new money coming in all the time. But again, don't be afraid to add to winners for that reason. Now, if you do the opposite, you got to get out at a certain time. You can buy a little bit at 11, a little bit. If you lose too much, you know, your average price, you lose 10%, get out. All right. Because if it goes from $11 down to $8 and you've doubled down at $8, that's great. So now you got an average price of 10 and the stock's trading at 8. You have a losing position. Now you're relying on hope. That's not an investment strategy. Okay. You want to just get out, cut your losses and move on, but don't be afraid to add to win, especially ones that you get at really cheap discount prices after a big washout in the market or a big washout in the stock. Don't be afraid to, again, you don't want to be chasing it up. The stock doubles, well, then just let it run, but it goes up, goes up. Go ahead and add, because you know that you cannot, almost certainly cannot lose money, because you'll just, as soon as it gets down to that level, I'm out. Today, nowadays, you don't pay any commissions for these individual stock trades. Doesn't cost you a penny, but more likely than not, especially when the whole market's washed out and it starts coming back, you can have that stop level at a guaranteed profit, and it works out really well. Anyway,
I think it's good that that you review like stocks that are not like you're able to review smaller stocks. Like I remember we were looking at that other like Mullen something.
Oh
like,
yeah,
because like you're never gonna hear of these small cap stocks in CNBC or Bloomberg. They're just too small. So the fact that people can get an actual professional, recommendation and conversation with you directly, even for whatever they're trading, it doesn't matter what they're trading. It could be Dogecoin,
exactly.
Fluky, whatever. You know what I mean? Like it's just
Yeah,
a benefit.
If I don't know anything about it, it's like one time somebody asked me about something. I go, well, the stock's brand new. I don't know a lot of. I was not involved in the IPO. I don't know anything about the company. I mean, I know what they do, and I heard about it, but I don't know anything about its fundamentals. And I can't tell you anything about the technicals because it's only been traded for 2 weeks. I just said, I'm sorry, I'm no help on this one. Sorry. I mean, I'm not going to make something up. So, but the vast majority of the time, we can give you a good idea, no matter what the stock is.
Right. So let's go and look at what we have here. All right, let's take a look here really quick at a firm.
Sure. Whoops. Okay, now here's again, it's going back to what we were talking about. I like this company. It looked like it was finally trying to break out here. So that's why technical analysis is not perfect, right? Because we finally got, it did give us kind of a mini higher high. It would have been better if it got by there, but it broke above its trend line. It looked like it was going to break out. Then of course they reported earnings and the stock just got crushed. But again, you can see its RSI chart quite oversold. Let's look at the weekly RSI. I'm sure that's very oversold as well. See, that's over. Again, it hasn't been trading. It's only been public for a while, but about a year or so. But that's okay. Once you get, certainly once when trading by a year, you can look at the chart. But the again, the MACD chart trying to curl up. See the last time it curled up? Now, if you want to own it for a long-term basis, the MACD chart is not what you look at. But if you're looking on a short-term basis, you can see here. Shoot, my thing's trying to freeze up a little bit. But you can see that the positive cross there took it. Okay, 70%. 70%. Think those you bought the 1 or 2 week options there. You made several 100% on the positive MACD cross. See this one here? That was a head fake, so we didn't chase it. This one was a good one. Look what it did. So we're going to wait and see if we can get a more positive MACD chart. This one's going to be a real good one to look at. We're not quite there yet. It is coming off that oversold condition, so that bodes well for the stock. And on a longer term basis, like I mentioned, let's look at the stock on a closing basis. On a longer term basis, again, you like to see that higher high, but the higher high is going to be way up at $75. So that will give you the confirmation. But you ought to be able to get in before that. But again, here's a stock that all the leverage has already been wrung out of it. Let's look at the short interest. Look at that short interest. See how high it is, and it's it's 8% of the float. That's not huge, but it's still pretty big. Once this thing goes, you get that positive MACD chart, those shorts are going to get squeezed. And again, I'm a little cautious on the market because God only knows what's going to happen in Eastern Europe. So you don't want to bet the farm on anything right now, on any individual name. But this one's is getting ripe for that kind of rally. If we get that washout, this is another one that's going to look really, really good and make some people a lot of money, especially in the options market.
And specifically talking about like these kind of growth companies, when do you think they're going to be like out of the woods? Do you think like end of 2022 or?
Yeah, I think, well, it's just, the overall, I think what we'll get is we'll get a big head fake at some point this year in the summer, probably the summer, but late spring. It may even happen soon if we get the washout trade in March, like we frequently do. But then, they get in that fall seasonal, that other seasonal time frame where things get a little hairy in September and October. No guarantee that we have another problem like that. But again, it's going to take time for the impact of the Fed to really be felt and for investors to really unwind some of that leverage. But I'm going to tell you, we're going to have in the next year, certainly the next 18 months, and probably before the end of this year, probably in this coming fall, we're going to have an unbelievable buying opportunity for so many of these companies. And again, there's the companies. It's kind of like the 1999, 2000s. So many companies that weren't going to ever make money were high flying. Now we got companies that are going to make money, and some of them, like Facebook, already is making a lot of money. They're going to do extremely well. They're going to provide unbelievable opportunities. But if you're 100% cash if you're 100% in the market, and you don't have any cash in the sideline, you won't be able to take advantage of them. And if you've lost a bunch of money in this downturn, it's going to be, when the leverage gets unwound, you're going to be afraid. You're not going to be willing to step up. And so that's why I just think it's so important for people who have the time to be an active trader, to take advantage of the tools that we now have so that we can have the money and have the confidence when there's unbelievable opportunities that came up in 2003, like came up in early 2009, like came up in March of 2020 when the Fed came in and just plowed all that liquidity into the marketplace. Those are the types of things that are unbelievable buying opportunities. And not everybody can take advantage of them because they're getting margin calls. Others can't take advantage of them because they're frozen like deer in headlights because they've lost so much money in the previous couple of months. They don't know when to get back in. It's like I said, not only does it help you get some money and make some money to put to use for those longer term bets, but it gives you the confidence to do it, which is a big part of the game.
Right. Absolutely, Matt. And well, I mean, this has been a great session so far. So definitely, I know that you are, a busy guy, and so appreciate, you being grateful with your time here, with all the chat members that are here and all the other folks that are joining here on the YouTube and the Zoom call. So I think with that, we do have, quite a session here. Matt, how are you doing with time?
Yeah, good. We should probably wrap things up a little bit. I do have that interview coming up for CNBC Asia, and I got to get ready for that, and then take care of tie up a couple loose ends here before that. So
don't forget to give a shout out to the chat room there when you're on CNBC. But yeah, man. So do you have any closing remarks here, Matt, on the folks here? Not just on what you're looking forward towards the market, but also what you'll be doing there in the chat room with the folks.
Yeah, well, tomorrow's going to be an interesting day in the chat room, is because, we'll see. We had this sell-off today, and what is that going to do? Is that going to turn into something bigger again? Or or do we keep moving higher? I mean, the next couple of trading days are going to be very, very important about what's going to happen over the next. So I'm saying the next 3 trading days are going to be very important to how the next 3 weeks go, and so we're going to be watching those very closely. Right now, I'm leaning to the bearish side of things. Because I really feel that even though Chairman Powell said today that they're since the invasion they're going to be a little bit more nimble, but he had Cleveland Fed President Mester today was saying we got to get started with this stuff, and she's not a major hawk, but they're between a rock and a hard place. The Fed has no choice but to tighten because of inflation. It's not like 2018 where they can pivot on a dime because inflation was a non-event. They're going to have to continue to tighten. That's going to create headwinds for the stock market, going to create a lot more volatility. And he kind of he said things in the last 2 days publicly because he needs to be calming the market so that things don't get out of control. But he did emphatically. I mean, today he was asked specifically, "What do you think of Chairman Volcker and what he did?" And he said he's one of the titans of American finance in American history. And he has, and let the history show that I said that we will do whatever, like he did, do whatever it takes to make sure inflation doesn't get out of control. And the reason for that is that even if he tightens during this crisis in Eastern Europe, it will cause pain. He knows that, but he also realizes that it'll cause more pain if he does nothing, because inflation will skyrocket and make it a bigger issue for a longer period of time. And I mean, sometimes, as the saying goes, they have to take take away the punch bowl, even though the party's still going. And this is what they have to do now. And we had professor from what's his name, but from University of Pennsylvania, was always bullish. He's saying, no, we have to. They have to talk. They have to raise rates. They have to tighten, and that's what's going to happen. That's going to cause more volatility this year. So let's take advantage of it. The tools are there. We've been taking advantage of it really, really well. We saw a couple of examples. There's so many more examples of how we've been able to take advantage of this in both directions, because we're going to see the volatility in both directions really for most of the rest of this year. So that's really what we're looking for. And I hope you'll stay on here as we finish up. So Rodrigo's got some closing comments can really kind of sew things together for you. And again, I hope you guys will take a look at it, and we'll see you on the chat room. Again, I'll be on if you're out there in the Pacific. You'll be Asia Pacific area. You'll be able to see me on CNBC Asia in about an hour. Thanks so much, and good luck with everything. This is an incredibly great time for the market. There's fear. If we can embrace it instead of, let's not fear this liquidity, this volatility. Let's embrace it and take advantage of it. And those who embrace it and take advantage of it are going to come out the other end so much better prepared, and I think a lot more money in the bank.
Right, good stuff. Well, thanks a lot here, Matt, for being here with us, and I'll see you there in the chat room. And I'm going to show them here a couple of things there. But thanks
Super.
for being here with us. And
great. Thanks, Rodrigo. We'll talk to you real soon.
All right, sounds good, Matt. Absolutely, man. Folks, so what you're seeing right now is the chat room where Matt is posting the trades. So I want you to look, if you have a chart, just look at the QQQ chart. Okay. So from today, well, since yesterday, he was already buying puts. And we're talking March 4th expiration puts. And also buying SQQQ calls as well. So rolling them out to next Friday. And he was rolling out another trade there from CVX. And today at 11:36 a.m., it's the timestamp there. You can look at the chart and everything. He started to buy more puts. All right. So then at 12:33, added more puts. And he was adding at a specific level. He wasn't adding on the bottoms. He was adding at the right points. So that's the difference in time. Sometimes you have to wait for the right moment. That's why he puts the exact entry and exit there. So again, you could see 12:33 adding more puts, 12:39 adding more puts, 2:12. I'm going to go ahead and add to my QQ, adding more puts, right? And I mean, you guys saw what happened in the markets today in the QQQ, right? Just for the day. So these puts are pretty up, pretty high up today. He's still holding them. He has not sold them from what I'm seeing there. But this is what I'm talking about when I say like the volatility. When Matt is trading volatility, he's actually trading like in and out. And keep in mind, those SQQQ calls are green as well. So he was already entering that trade. He was already entering that trade from the day before and prior. So it really comes down to just timing the market. Really, that's what Matt does really well, folks. So I'm gonna go ahead and if there's no more questions here about the chat, I'm just gonna go ahead and leave I'm gonna leave the link, folks, so that you can join. And in there, if you have questions, there's an email, a number you can reach out. we'll be more than happy to answer questions, things like that. And Matt does have the session correct on Tuesdays. It's Tuesdays at 11:30 Eastern. That's just for the chat members. And you can see in the chat where he's basically posting the entire trade as well. The contract, the symbol, the date, expiration date, all that stuff. So pretty simple, easy to follow. And then you have the other chat. In the other chat is where everybody's talking. Right now, let's see, it's 6:30. People are still talking here about stuff that's happening in the market. So that's pretty interesting. You always have that community. It's always open 24/7, guys. So if anybody does have questions, reach out, folks. Thanks a lot for being here. Appreciate a lot the energy today, folks. Great session with Matt. So with that in mind, folks, thanks a lot. Stay safe, and we'll see you next time.
Thank you.